Bloomberg Audio Studios.
Podcasts, radio, news.
So Chevron beat expectations for a second quarter. The company increasing global production by 12% versus a year ago. Its upstream side of the business was super solid. Now going forward, though, it's all about its acquisition of Hess, and that's mired in arbitration with Exxon. So we spoke to Mike Wirth, chairman and CEO of Chevron, and asked him about, we started off by talking about the short-term Permian production outlook.
It was a strong first quarter overall, certainly operationally, financially, and from a shareholder return standpoint. I think operational highlights maybe were the key. And, first quarter production was up significantly. It was our highest first quarter ever. And in the U.S., we were up 35%. Part of that, the acquisition of PDC. And then another part, as you say, 12% growth year on year in the Permian Basin, where we just continue to see productivity and efficiency gains. And we're getting more production out of the same inputs: wells, completion, rigs, completion crews, et cetera. So we expect to be, relatively flattish through the first half of this year. Growth in the second half to exit over 900,000 barrels a day, on our way to 1 million barrels a day in 2025.
So that's really back half weighted. Why is it back half weighted? What's going to sort of change?
Well, we're bringing another completion crew on in the middle of the year. So right now we're building up an inventory of drilled wells that are not yet completed. And then when that rig comes in, we'll start to put those wells on production. So it has to do with optimal capital efficiency as we bring equipment in, and nothing unusual. It's really part of the normal program there. It's not a straight line every quarter.
Mike, how is demand looking overall across the sector?
We continue to see pretty good demand, Romain. Certainly the economy here in the U.S., although the first quarter data would suggest it's slowed, we've not really seen any signs of that. We're seeing good, strong demand growth in the U.S. We're seeing strong demand growth in Asia. Europe, perhaps a little less so. But overall, last year demand was up over 2 million barrels a day. We expect it to be up maybe 1.5 million barrels a day this year. And so, the demand side of things is very healthy.
When we talk about sort of what drove earnings, and not only in this most recent quarter, but in the quarters past, there was a lot of talk, Mike, about capital efficiencies. There are a lot of people now looking at some of the production outlook, looking at potential acquisitions, and some of the other moves that you are making, as well as some of your competitors are making, and really wondering whether that sort of era of capital efficiency is over.
Well, I can only speak for our company, and I tell our people, capital discipline always matters. It matters during good times. It matters during challenging times. And we're in a long cycle business, so efficient capital investment is fundamental, because our investments pay out over a very long period of time. And we try not to swing our capital activity up and down with the oil price of the day, but stay very focused on executing investments that will deliver value over the long term. So our budget is in a very steady range. We don't intend to raise our spending because of market conditions. It's part of a much longer term plan. So capital discipline is as important today as it's ever been.
It's interesting, Mike. I feel like the conversation at one point was M&A is capital discipline because it's so expensive to explore and to do new fields. But then at the same time, you guys announced potential ambitions there in Namibia, an operating stake there in one of the areas, License 82. What's your outlook for Namibia? Like, what do you think that's going to look like? How invested do you want to be? How aggressive do you want to be there?
Well, it's certainly a basin that has seen some early exploration success by others. We've got one large block off Namibia that we expect to put an exploration well down in late this year or early next year. We've just acquired a large interest in operatorship in a second block there in a basin that has some of the signs of things like we saw in Guyana a decade ago. So there's a lot of work to be done, and there's no guarantees in exploration. But we're always looking to bring resource into our portfolio through exploration, through technology, and then also through M&A. And in any given period of time, the balance of those may shift around. But fundamentally, we need to be good at all three of those over the long haul in order to continue to create value.
Galp announced a big discovery in Namibia last week and is rumored to potentially be selling some of its position. Would you be interested there?
Well, we certainly are always interested in acquiring a position in attractive blocks. I can't comment on any particular opportunity. We keep those discussions confidential. But Namibia and the Orange Basin offshore there is an area that we're quite interested in and very active in.
I am curious, Mike, about the other big deal that everybody wants to know about, and that's the deal with Hess, the expansion into Guyana and those oil fields there. Where do we stand right now with regards to what you're doing internally to close that deal, and where do we stand in the arbitration with Exxon?
Yeah, Romain. So maybe 4 points. Number one, integration planning has been ongoing since we announced the transaction, and that's gone very, very well. Number two, the proxy will be mailed to Hess shareholders before the end of April, and the shareholder vote will occur before the end of May. Number three, we got a second request from the Federal Trade Commission, and we expect to certify substantial compliance with that in just the next few weeks and be through the antitrust review process. And then that leaves the fourth work stream here, which is to work through this arbitration process relative to the terms of the joint operating agreement. That is likely to take a little bit longer. And we'll have to see how the exact scheduling plays out on that. We don't have those dates pinned down just yet.
Do you think, though, that you can get this deal done this year in 2024?
Well, that's certainly our expectation. We're working closely with Hess in order to do that. The arbitration process has been initiated, and ExxonMobil indicated in an investor conference last month that they think 5 to 6 months is what this could take. We certainly believe that's a sufficient time frame within which to clarify the specific contract provisions here. And I think Hess has actually, in their filings, indicated that they've requested a hearing in the third quarter and a decision in the fourth quarter. So that's the timing that we're working toward in a process that is still unfolding.
Mike, are you guys having parallel negotiations aside from arbitration or no?
We're always open to conversations. In fact, before the arbitration process was initiated, we had been in conversations, and Hess had been in conversations with the other members of this joint operating agreement, and in an effort to understand their concerns and to address those concerns and seek resolution. The arbitration really ended those discussions at the time, and that's the path that we're on today.
Okay, so not talking quote unquote yet, yet. Mike, internally, are there plan B conversations? Most experts think that you guys are going to win this, but if you don't get Guyana in some capacity, what is a plan B?
We had laid out a very strong plan before we announced the Hess transaction, increasing our free cash flow at a 10% compound annual growth rate over the next several years. We've got more resource in our portfolio today by a substantial amount than we had just a decade ago. We've outlined growth plans for the next 10 years in our investor conferences. And so we have a very strong foundation going forward. We like the Hess transaction. We think it's good for the shareholders of both companies. We think it makes our company even stronger. But it was done because it would make us a better company, and it would create a premier company to compete and reward shareholders and be positioned for the energy transition over the long haul. But we were in very good shape without that. And so this is, we've got a good, strong foundation in either scenario, but we certainly are confident that we do have, the right interpretation of this contract and expect the transaction to proceed.
All right, Mike, before I let you go, you know this question's coming. It's an oil price question. Do you feel like an oil price right now accurately reflects supply and demand versus geopolitics?
It's always a difficult one to answer, Alix. It does reflect supply, demand, and expectations about geopolitical risk. We see the price tend to bounce around a little bit based on what's happening in different parts of the world, the Middle East in particular. But we've got a market that's relatively well balanced. We've got inventories that are a little bit on the low side. And so it's a market that's priced accordingly. And the risk for potential supply interruption exists not only in some of these areas where there's geopolitical risk. We're headed towards summertime in the fall, which in the U.S. means hurricane season. And so there are different ways that supply could be threatened against the backdrop of strong demand that we discussed earlier. And so prices are probably a little higher than we think the long-term price is likely to be. And I think it reflects the fundamentals and then these additional risks that exist.
That was our conversation with Mike Wirth, the CEO and chairman over at Chevron. And if you take a look at the equity price, say, over the last year, Chevron has underperformed Exxon just in the last couple months, but it has given it a run for its money. Like, it has made up a lot of what it has lost.